I am curious here, Andrew, about this whole issue of breadth. I mean, we make a big deal about it in the media, but is there a case to be made that, you know what, maybe it's not all that bad to have NVIDIA and chip stocks and software stocks leading the whole market?
I agree with you, Romaine. I mean, at the end of the day, if you look at the best, stock price momentum, it seems to be aligned with earnings revisions. In other words, the companies with the best revisions are doing the best, and the companies with the worst revisions are doing the worst, which means that what's driving stock prices is fundamentals, and the fundamentals are good. So when people say, well, it's crazy, the narrowness of the market, I say, whoa, whoa, whoa. These are the companies that have had the best earnings revisions. They're being rewarded the most. That's it's a very, very logical market. Now, having said all that, I don't agree at all that it's bad going into earnings season, because this lack of breadth recently means there are a lot of companies out there that have had very good fundamentals, but have actually not done much recently because everyone's so focused on AI. Mm-hmm. So I think the setup into second quarter earnings is really good because it's an opportunity. I'm not saying run out and sell your AI stocks, right, but look at companies that are fundamentally doing well that have kind of not done much recently.
But to your point there, Andrew, some of the concern heading into this earnings season as well is the idea that expectations are a lot more elevated than what they were maybe in the past. And that sets up the potential that if you do get misses, whether on the earnings themselves or the guidance, you could see a more severe reaction to the downside.
That's true for the tech stocks, because those are the ones that are most overbought going into earnings season. So what always scares me is when stocks are red hot and expectations are high. But for the most of the market, that hasn't been the case recently. Most sectors have really not done well. I'll give you a perfect example. The industrial stocks have really been hurt. A lot of the infrastructure stocks have really been hurt recently, and I don't see that going away. So I see that as a great setup. So I don't, again, the bar is higher in terms of recent performance. It's for, yes, the tech stocks, and maybe they meet and the stocks don't do well but for a lot of sectors, they haven't done particularly well recently.
So, Andrew, how much of that, though, is a value call? Because the value trade still just can't get legs.
Sure, I agree with that it's financials currently. Value stocks have done very poorly recently, but again, their fundamentals haven't really valued it. So I think, or validated it. So I do think your point, Alex, which is it does push us more as a core manager into the areas of value where we say, well, what stocks are doing well fundamentally that haven't done well recently? The setup seems to be good. So I think the banks going at, the end of this week, I think the setup is pretty good. I don't see negative revisions. Mm-hmm. I just don't see it. I can tell you that what matters is not this year's revisions. What matters is next year's revisions, because at the end of the year, we're going to price off next year's revisions. And if you look at FactSet or any Bloomberg or any data source, the bottoms-up revisions have gone up. Yeah. They're not going down. So I don't know where these people are coming up with those that revisions are heading lower.
Well, I mean, I think for tech, heading lower, at least for the Mag 7, it's like from 24% to like 16. So they're not like in negative. But does that wind up implying, though, are we in borrowing growth from next year, though, if we continue to kind of grind out earnings, or no?
Without a doubt. You're absolutely right. The market is a forward predictor. And so it's predicting earnings strong this year. I think the market is going to have a much better year this year than it will next year, even though next year we might have better earnings. So the stock market looks ahead and it's saying, hey, we could make 280 of earnings next year, and we're going to price off on December 31st. We're going to price the next 12 months is going to be 2025. And could that be 280 or even north of 280? Well, you know what? That number keeps going up every week. So I think is a real possibility.
Andrew, I do want to get your thoughts on a little bit more of a short-term outlook. There's been a lot of discussion here about the potential, I guess, malaise that might wash over this market, not only because of the seasonal issues that we normally have during the summer, but of course with the big election up ahead and a lot of folks who don't necessarily want to be in the middle of that. Is that a concern for you at all?
Well, I mean, I've been pretty vocal this year, saying, look, the stock market hates uncertainty. And because we have two candidates who have both been president, that's less uncertainty, and therefore I expect less volatility. Now, if that changes, and statistically we know that coming out of the conventions, if the challenger is ahead, markets struggle because the challenger, we don't know what we've got with the challenger, there's more uncertainty. But, I've all said, hey, it's not true this year because both have been president. If there's a change in either candidate, that will increase the uncertainty, and therefore I think that increases the volatility. So that is definitely a risk at a time when, the market's done pretty well. The flip side, and we're going to get a CPI print later this week, but the Fed, they're getting what they wanted, which is a lower inflation, economy slowing but not breaking. And if the Fed cuts, in September, I think the market, at least initially, is going to like that a lot. So I think there's some offsetting, kind of bull bear arguments.